Alrighty, I think we can probably kick off now. There might be a few more coming through, but this session is being recorded, so we'll send it through afterwards. Firstly, welcome everyone for coming along this afternoon. I think most people are probably quite happy that we're doing this online, particularly those in Auckland right now. So yeah, won't talk about the weather too much. What the plan is today is I'll take through a very brief intro of private wealth advisors, and then I'll hand over to Jarrod. Now, this is the first time we've done a webinar, so hopefully our technical side is pretty much covered off. What I will do is make sure Jarrod's joined and then go through this presentation very briefly. There we go. Okay, so disclaimer. I'm sure you've all seen these before. If you think we're offering advice, particularly in your personal circumstances, please ask myself, Jack, Roger or Grant regarding the advice side. So usual disclaimers, there might be a few lawyers in the room who have written and seen these a few times before. Alrighty, just to do a bit of a refresher on PWA. Roger founded the firm back in 2001. It's gone through a few iterations of names and finally settled on private wealth advisors. What's unique about our firm, or at least important to us about this firm, is that it's 100% owned by advisors. We're independent. We don't take any brokerage. We don't have any fund manager obligations or investment obligations. So what it means is we're able to ultimately invest where we believe is the best place for you to be investing. We currently manage over 620 million of funds, which puts us in one of the larger sides of independently owned boutique advisory firms around the country. And we also have a strong intergenerational wealth planning capability. Primary focus of what we do is preservation of capital. The way we see it is, first goal is to save the capital. The second goal is to grow it where possible. Because of our structure, it allows us to look for the best of breed. This comes back to our independence and our individually tailored portfolios, meaning we start from a clean sheet of paper. It's important to note that our investment committee is consisted of the 4 advisors, again, myself, Grant, Jack and Roger, and independent investment committee member, Chris Douglas, and my fiduciary firm. This enables us to make sure we're not all drinking from the same Kool-Aid and have a bit of a diversification of thought. Paul McCormick is independent director, and between that collection, it just means that we're all ultimately putting the client first, which enables us to sustain our long-term relationships, which is the gist of our mission. One of the important features that we offer is the variety of different structure of fees. So our background's largely in the banking background, and it was almost a one-size-fits-all approach, which doesn't always work. So Roger has set up a firm which enables us to put what the client prefers first, so we can structure an investment in a way that suits the investor. What I'll do quickly now is just take you through the Zoom session. Now, you should all be able to see on your screen an option that says Q&A. If you click on that and ask a question, please feel free to throw a dummy one up there so I can confirm it's working. I will jump in if it's relevant to the slide, or otherwise what Jarrod will do is go through his presentation and we can have questions at the end. Now, obviously it's not going to have the free flow back and forth that you would have been used to in these kind of sessions, but we'll certainly do our best to get to them as and when it's relevant. So without talking too much further, I will just quickly introduce Jarrod Kerr, who's Chief Economist of Kiwibank. He joined the firm in 2018, and prior to that, he was Director of Interest Rate Strategy at Commonwealth Bank. Prior to that, he's also had roles at Credit Suisse and JP Morgan. We've had Jarrod present to us once before and had raving feedback, so absolutely happy to, what colour is my hair? Sorry, yeah, the questions work. Absolutely happy to have Jarrod back, and very disappointed, of course, we can't do this in person. So Jarrod, I'll hand over to you if you want to steal the screen, and we'll go from there.
Yeah, sure. Unfortunately, my hair colour's very grey and getting greyer by the moment. Since we last spoke, yeah, obviously a lot's happened, and we are in what can only be described as extraordinary times, and we are discussing what can only be described as, very extraordinary measures. So We've gone from a central bank, which used to call its OCR reviews just that, OCR review, talking about a cash rate, to calling them a MPR, which is monetary policy review, because it's not just about the cash rate anymore. It's about trying to stabilize financial markets, trying to make sure investors have confidence, trying to make sure that you guys are being pushed out the risk spectrum. Now, I'll just share my screen. Are you seeing that, Ben? Sorry.
Not yet, no.
Not yet. Okay, sorry. Oh, something's going on here. Here we go. How's that?
Yep.
Nice. Okay.
Perfect.
So the title of my presentation is more from an investor's mindset. It's one of QE fueling markets, and that's the whole point. So what you'll hear the central banks say is, we're doing large scale asset purchases to lower interest rates. Okay, great. What does that really mean? Well, they're taking bonds out of the market, pushing the price of bonds higher, and in the process of doing that, they're driving interest rates lower. But what that also means is that they are taking bonds off us. So they're taking bonds off us as banks. They're taking bonds off fund managers and insurance companies, and they're basically making them go out the risk spectrum and saying, right, that bond is now expensive, it now has a very low interest rate. I want you to go out and buy council bonds or bank bonds or other corporate bonds. Get out the risk spectrum into credit. And we've seen credit crunch in, the credit spreads crunching in closer to govies. What do you do next? Well, you've then got to look at your portfolio and go, well, fixed income, the yield in this space is low. Putting money in cash, not getting a lot, particularly in after-tax basis. So I really need to go into other asset classes like property and equities. And that's why we find ourselves, I think, in an extraordinary situation where the world's going through a pandemic and the greatest economic contraction since the Great Depression in the 30s. But equity markets are at record highs because the response function of central banks this time round has been so much harder and faster, and the ramping up of QE and other measures like term lending to banks has been that much more aggressive to try and get on top of this early, that you are seeing that filtering through immediately into equity markets, but also property markets. And then of course there's the government side as well. You're seeing a lot more fiscal response this time round, and it is actually the fiscal response that we need. So my first slide here is just a few bubbles around the world. You know what's going on there. You know that we have a pandemic on our hands. The point of this chart is to show there are very big bubbles out there, and even with the latest outbreak, our tiny bubble is just that. It's tiny and it's relatively pristine compared to the rest of the world. What that means, however, is that we will continue to be very nervous about letting people into this country. So our assumptions, our immediate assumptions in May, when all this was well and truly underway, was that our borders would be closed for about a year. And Air New Zealand and other tourism operators and other sort of accommodation and businesses affected by this, it all kind of agreed, yeah, roughly a year, and then hopefully we're out of this. Whereas now it's become that much clearer that our borders in this world where COVID is not being brought under control will stay closed for that much longer. And even when we do think about opening our borders up, I think it will be a lot more gradual. We might let tourists in, we might let workers in, we might let long-term visitors in, but we're not just going to open our borders up willy-nilly. And what that means is that we will continue to see 5% of our economy effectively shut out of operation. So that means that our recovery will be that much slower, unfortunately, but that is just a new normal for now, right? We're just living with COVID, and I think that we're all just adapting to that expectation that we're not just going to bounce back, in 6 months or a year. This is something which is going to take a few years. And to give you some idea on the numbers here, I would almost ignore China's miraculous bounce back, the yellow line there, and I'd look at the others a bit more seriously. The advanced economies, the ones that have been hit particularly hard here. Emerging nations have also been hit pretty hard. And what we are seeing is what looks like a V kind of shape. But we don't really get back to the previous levels, of 2019 until we're well into 2022, 2023 for advanced economies. And the little bubble chart there on the right hand side shows you the dramatic swings in where growth was predicted to be prior to COVID and where it is now. And if you look at India, a country that was expected to grow at plus 6% and now likely to grow at sort of -10, -15%, or contract, I should say. That's a huge swing, and we're all sitting in that range of a contraction for this year. We're not on the G20 on this chart here, but we're in that sort of -7 to -8% for 2020. So a huge contraction, something we haven't seen since the 30s. These numbers are really quite astounding. So this is what our V, if you like, looks like. But if we go into another lockdown, or this lockdown's extended, or we go into another lockdown and another one and another one and another one, then the V that we thought we were on becomes more like a U, and it takes us even longer to get back to the sort of 2019 levels. Right now, we think we'll get back to those sort of 2019 levels in around the sort of middle of 2022, but with every lockdown, with every hiccup, with every mistake at the border, that gets pushed out another 2, 3, 5 months. And that's why we've drawn that lighter green line there. If the second lockdown lasts a little longer than we expect, then we could see more of a U shape. This is an incredible contraction, but it's also an incredible rebound that we have had up until last week. So we have, believe it or not, upgraded our forecasts. So when we were in the middle of the first lockdown, we came out and said, right, based on our modeling, which is very rough, we're throwing darts at a board here, but based on our modeling, we think we're going to get a 10% unemployment rate, but the risk to that is towards an unemployment rate of 13, 14%. We came out of lockdown, we had a sugar rush, and we thought, yeah, we'll just wait to see what that looks like. We waited 3 months, and it was sustained, and we thought, okay, maybe we should relook at our numbers. And the unemployment rate we still have going to 9%, but the swing, the risks around that number are a lot more balanced now. We actually think there could be some upside risk to that number. The official statistics that you may or may not have heard about 2 weeks ago, which showed an unbelievable decline in the unemployment rate. You ignore that and you look at the job seeker numbers, and you look at some of the other measures that were in the report, and there's definitely been a weakening in our labour market, but nowhere near to the extent of what we are still forecasting. And we're basically waiting for the wage subsidies to eventually end and see how many jobs have been saved and how many jobs have just been postponed and will be lost. But I think most of us are of the same sort of opinion that the full effect of the first lockdown and even this second one has yet to be felt, and it's probably going to come through towards the end of this year and into the start of next year. And what that means for inflation, so we've got a big contraction in growth, we've got a lift in the unemployment rate, which in itself puts pressure on the housing market and confidence and the economy in general. And then you put that onto what does that mean for the inflation outlook? Well, the inflation outlook is clearly to the downside. So it looks like we will see inflation running close to zero, which is obviously no inflation. There is a risk that we see a short episode of deflation, but there's also a risk that we don't. So it's reasonably balanced around that zero at the moment. The imported inflation with the strength of the Kiwi dollar has been soft, and of course the domestically generated inflation, the stuff that we generate on our own accord, is also likely to be quite soft over the next year. So with that, you have a central bank with a dual mandate. Inflation fail. In fact, they failed on inflation for 10 years. And full employment, well, based on the latest market statistics, they've met that, but no one believes it. And clearly the risk is that we're moving away from full employment, and the higher frequency data suggests we already have. So dual mandate, both of them not being met. And you had a central bank last week pretty keen to not only increase quantitative easing, but explore other options. And one of the reasons why they're wanting to explore other options is because the housing market looks like it'll go through a small dip in all of this. Not a big one, but a dip nonetheless. So again, in the height of the COVID-19 lockdown, we sat down, we ran our models. It showed if you've got a 10% unemployment rate, historically speaking, that means housing comes under pressure. When you've got the labour market under pressure like that, people start defaulting. You see default rates at banks starting to lift, and you also see house prices coming under pressure. So we pretty much put that straight in. We wanted to prepare the bank, but also customers, brace yourselves. And we're looking for a 10 plus fall. We've now revised that to a 6% fall. So again, the risks around the housing market have clearly moved to the upside. The strength that we've seen in the housing market in the last 3 months has been, well above, I think, anyone's estimations. How we bounced straight out of lockdown and cleared basically a bunch of transactions that weren't able to be done, and then put new listings on, and new listings were snapped up. The fact that banks went into a bit of a mortgage rate war, undercutting each other in mortgage rates there really did spark an interest, particularly in first home buyers. A few other tweaks around LVRs and test ratios and these sorts of things have also gotten people fired up in the housing market. So right now we're actually running at 9% plus. So house prices are up over 9% in the last year to July, based on REINZ numbers. But being the cautious creatures that we are as economists, we're still saying there's still a risk that there's a bit of a slowdown before things bounce back, based on the strong fundamentals, which I can get into a bit later. So with all of that, and the central bank not meeting their mandate, the government wanting to do whatever it takes to make sure that the economy doesn't come out with too much scarring, we've seen quite dramatic responses from both the government and the central bank, and importantly at the same time. So working together through this crisis has been, I think, a very important development. You've got government announcing packages on the one hand, and you've got the central bank announcing quantitative easing to buy the debt that's needed for those packages on the other hand. It's been a very well orchestrated response to date. Is there more to be done? Of course. A lot of what we've done so far in offering this and giving wage subsidies has been more like a band-aid rather than actually setting us up for a a new world, a post-COVID world. So I think there's still a lot to be announced and a lot to be done, and potentially more than the 14 billion that they've got sitting there. But to date, I think the fact that we came out of lockdown the way we did, we rebounded the way we have, the wage subsidies clearly worked. Be interesting to see what happens when they roll off, even after the extension. But the central bank response has been pretty strong as well. So from the government's point of view, this is exactly what you want the government to do when you're in a recession. You want them to open the checkbook. Sorry, we don't accept checks anymore. You want them to open up the the bank account and do what they can at a time when other people are nervous to boost growth. And we should see a fiscal impulse, so what the government is likely to add to growth in the next year of over 6%. Now that's huge, absolutely huge. And you compare that to the GFC of sort of 3.5%, and it gives you an idea of how hard they've gone this time round. And of course, in doing that, they're going to run deficits. And in running deficits, you need to increase your debt issuance. So we're going to go from a bond market of around $65 billion outstanding to a bond market of around 215 billion outstanding. But the central bank's going to buy most of that. So the interest paid by the government on the debt that they are taking today to do these measures to build a better economy for tomorrow could be negative if the central bank takes the cash rate to minus 25 or minus 50 basis points. Most of your government bond curve will be negative, which means that the government will issue $100 worth of 5-year bonds. You receive them and you get $99 back. The government only has to pay $99 back. It's a weird world, but that's what we're looking at. And I think the central bank made it very clear last week that that's an option. It's something they're openly entertaining or actively preparing for. They've given us guidance that they want to keep the cash rate at 25 until March next year. But then if things deteriorate, there'll be a rate cut. And given what they've said in the past, they won't muck about. That rate cut will be, a good 25 to 75 basis points below zero. So they'll cut to either minus 25 or minus 75. And most of us think that they'll go to the sort of minus 50 level and see how that works. So in doing that, they are really squashing retail rates, and retail rates move closer to zero, but they won't go below zero. Wholesale rates will go negative. And in doing that, you will see, like I said, wholesale rates potentially going negative. Wholesale rates are what we deal with. And, so a 2-year swap rate is what we price our mortgage rate off. And if that goes negative, then clearly the 2-year mortgage rates that we offer, the market can also start to decline. And that's precisely what is meant to happen. So from my point of view, though, I am probably the only economist out there that's not calling for negative rates at this point. I believe these are the tools in order of effectiveness. And the reason I've done this is because I am quite against negative rates. I believe the most useful tool is LSAPs, so the quantitative easing, the large scale asset purchases. I was the one that was sort of saying they should go to 100 last week, while the others were saying they probably won't do too much, because I do believe it is the most effective in pulling yields down. And given they can buy 60% of outstanding debt, they can get a little bit more, involved earlier, front load some of the spending, and they can do more in terms of buying other assets as well. I do think that's probably the safest, most well-known and respected response in the current environment. The next one is term lending to banks, and I think that's important because term lending to banks basically offers banks another source of funding. So instead of fighting for retail deposits, we can actually go to the central bank for funding at a rate well below retail deposit rates. And what that means is retail rates come down, deposit rates, but also retail lending and business lending rates come down. That change in funding mix has worked overseas. They've used it to great effect in Australia, but also in other countries around the world. And that change in mix really does have quite a significant impact on the retail rates. And I think that's probably the next best option. But what the Reserve Bank wants to do is combine that with the negative rate to make the negative rate look effective. The third is FX intervention, which again is limited in its success, and it depends on market conditions at the time, but you're basically selling Kiwi dollars of which you can print unlimited amounts in order to buy probably Aussie dollars, a few US and some other currencies around to try and get the Kiwi dollar down for our exports and to put a dampening pressure on inflation. So given that, I think if we move into next year and things have worsened, the threat of negative rates, but also the threat of FX intervention, will see our currency come under significant pressure, and we'll see our currency fall into the 50s, potentially to the low 50s, but actually probably do even more against the Aussie dollar because the RBA are not fans of negative rates. So I agree with the RBA on this. I just want to go through our internal data, which has actually been really, really interesting in how we've dealt with the crisis. And what we noticed was, obviously we went into lockdown, but as soon as we came out, we actually did a lot more on certain things. Like we spent more money in restaurants and bars than we were prior to the crisis. We spent more money at cafes. I think we've seen a permanent shift higher in online purchases. So this hasn't died away. There was a sugar rush and we thought, oh, okay, that'll last a few weeks. Okay, maybe it'll last a month. Oh, actually, maybe, oh, it's lasted 3 months. So it seems that there's been some interesting changes in our data. And it sort of showed us that we're simply spending more than what we were prior to the crisis. And it's held up in things like, beauty and hair, which we thought might have just been in spike, clothing, spending on pets. We spent a lot more money on pets. So I think being in lockdown, a few people went out there and decided to buy something furry and entertaining for the next lockdown. I guess they're glad they have now. But a lot of money was spent on renovations. So being locked down, you're taking a good look at your house and going, well, actually, there's probably a fair bit I could do to this place. And they've gone out and bought some paint and a brush, and away they went. But we really have been amazed at how, some spending like butchers and petrol and that's gone back to normal, but how a lot of our spending has just been simply far above what it was before. Movies obviously still well below, but then sporting events, spending more money on sporting events. The Blues attracting record crowds, online entertainment, structural shift higher. We're used to it now, structural shift higher. To explain some of this, well, some things haven't quite returned to normal, but the hotels and accommodation was much higher than we anticipated. So this is Kiwis not going overseas through winter. We've had a bit of a winter bump and traveling domestically. So actually we saw a lot more activity over winter than we would have thought, because Kiwis were forced to to have a holiday here. So we sort of looked at this and we thought, well, how does that all make sense? What we noticed over lockdown, a lot of us came out of lockdown with an extra, 500,000 or even a couple of $1,000s in our bank accounts. We noticed that bank accounts actually lifted over the lockdown period, and then we went out and we sort of spent that extra money. So that explains some of it, but that was the sugar rush we were thinking of. We've also seen a greater use of cards, basically, and this is card data. So in a contactless world, the use of cash and the use of our ATM machines has actually declined, and the use of credit cards has actually increased. So some of this might just simply be inflated by someone not spending a $50 bill and actually using a plastic credit card instead, which is fine. That doesn't actually mean that overall activity's done a whole lot, but the fact that we bounced back so hard, so fast, and it's been sustained for 3 months really gave us the confidence to turn around and say we're more resilient than we give ourselves credit for. The outlook, I think, is, well, it is a lot better than what we thought in May. Let's revise our forecasts up, and let's have another rethink, later in the year, once we've seen what's happened, once the wage subsidies have come off, and once the housing market's actually been through, a spring period. We want to see. It's easy, I think, to have record months in a winter period. Let's see how record the sales are over spring. So speaking of housing, the one thing that I like to point out from an investor's point of view is the rental yield, and how this really does explain a lot of what happens in our housing market, particularly when you're comparing regions to large cities, and how large cities tend to drive the initial lift in house prices, but then the regions tend to catch up to a certain extent. And that is simply because rental yields blow out. And we saw that in sort of 2015, 2014, where Auckland was doing its thing, but then we saw, the price to rent in places like Gisborne and Whanganui and Palmy all reach up to very high levels, like 6% or more. I remember stories of people in 2018 showing me houses that had rental yields of nearly double digits. You think, well, that's pretty attractive in a world where interest rates are declining. So one of the main reasons why we lower interest rates as central banks and policymakers is this. It's to say, right, a rental yield of 4%, which you can get in a number of the regions, is pretty attractive compared to a mortgage rate of 2.5%. Whereas obviously it's not when the mortgage rate's at 5-6% not so long ago. And what we're seeing is, since basically 2016, those rental yields have started to come down as the regions have played a pretty big game of catch up. What we're going through now is quite interesting, where you see Queenstown. Sorry, I didn't pop up on the bottom of that chart, but that dark blue bar at the bottom is actually Queenstown. You've seen rental yields in Queenstown drop to near 2%, and that's basically because rents are down 16% over the last year. I mean, the average rent in Queenstown was about $650 a few months back, and now it's sort of $480. So Queenstown's one of those interesting places where you've had a lot of Airbnbs on the market, making really good money on international tourists, all of a sudden being thrown onto the market for long-term rent, and that's pushed a pretty sharp decline in rents. Seen that in Rotorua as well. But then elsewhere, where that rental yield that I showed you before was quite attractive, you've seen Palmerston North, Gisborne, others where there's a shortage. you've seen rent really pick up, and those areas are also attracting more investors these days. Even young families leaving Auckland, to be honest, looking for more affordable places to live. You've seen on the left-hand side there the annual price growth really pick up in some of the regions. I mean, Whanganui at 27% in the last year is simply phenomenal, off a low base of 370,000, but a pretty remarkable increase in price. And we think these sorts of themes will continue from here. And the reason why we're still relatively, upbeat on the housing market, with saying things will come off a little bit as we go through this awkward period of unemployment for the next 6 months or so, but then we bounce back, is because mortgage rates are low. We still believe we have a chronic shortage of affordable dwellings, and our population growth had gone through the largest migration boom ever recorded, which points back to the second point. Chronic shortage of affordable homes because our population spiked the way it did. We got to 5 million pretty quickly, and most of that was driven by migration flows. The outlook for population growth has clearly changed in the post-COVID world. We've got net migration pretty much by definition heading towards zero. Even though we continue to take Kiwis in, we think that eventually we will take in most of the ones that want to move home, and there will be a period there of not much activity at all, and that'll take some of the pressure off the housing market, but certainly not enough to drive away any shortage. And that significant shift lower in mortgage rates really is a big driver of sentiment in housing. I think that mortgage rate war that we went through a few months ago sort of ignited the fire and got a lot of people excited. And I noticed just on my street, five places have popped up for sale, and they've all sold, which is interesting. You hear similar anecdotes around the place, and the data that we've seen has been really quite amazing. REINZ, Barfoot and Thompson, CoreLogic, these places recording huge volumes for winter months, and bounces in price, but that momentum looking like it's continuing into spring, which is important. And this, I guess, shows the Auckland moving first, as we did, but then really kicking up in 2019 and looking like we were going to have a good year in 2020, but the region's playing catch up to Auckland's move. The population part is interesting. We really don't know a lot about the net inflow, so we're all just guesstimating that things will slow down, but then eventually when we open ourselves back up again, net migrations, New Zealand will turn positive again, and that's probably the largest contributor to our population growth. So the estimates that the UN do, which is pretty good, but most countries go out 100 years, and our population doesn't peak, which is a really interesting thing when you think of the demographic problems that Japan, Italy, large parts of Europe face, and then you sort of think about New Zealand, and we simply don't face the same magnitude of problems because our population continues to increase, and we continue to plug holes in the demographic structure. We do model housing, or attempt to. I think I showed you all this last time. We've updated it recently. The stats obviously played around with their population estimates. Would be nice if they could get a census right. And demand supply imbalance there, simply more people, more demand, and that has outstripped what has been quite a decent increase in supply in the last few years. And what proves that is the number of people per dwelling. So the number of people per dwelling has basically been declining since the 70s, and then it picked up. And I think that's a case of people having to live together in an expensive environment where they can't actually get out and find that dwelling that they need, and that there's probably the best bit of proof that there is a significant shortage in housing, despite the fact that price is obviously well supported. That there really does ramp home the fact that we need more dwellings, and they need to be affordable ones, not high-end expensive dwellings. And this sort of hammers home this idea that our culture is changing a little bit with migrants coming through. We are more willing to live, in higher density dwellings. We need to build more, multi-dwelling units. And those are our forecasts. So I think I'll hand over for some Q&A.
Yeah, sounds good. I've got a few coming through, just while people have a look through your forecasts. So you've probably answered some of these anyhow, but we'll go into it. So one of the questions we've got come through, we're seeing housing market increase due to the returns you get from bank deposits. So you talked about obviously the mortgage rates. Are we seeing people pay cash and without actually borrowing to buy just purely because of the rates? You have access to that information?
I haven't heard much of that. No, that's probably better from a real estate. So if people are paying cash, they probably won't be showing up too much in the bank numbers, unless of course the money's coming out of a deposit into there. Mark Barton is on the line, and apparently we're flush with cash and deposits still. So I don't think we've seen an exodus like that, but that would be an interesting stat to see whether money's being pulled out of, cash or other investments to jump into property. But no, I haven't heard of a rise in cash buying.
What would be the risk to the bank if that were to happen, where that cash is coming out of the funding line for the banks? Are they going to be able to access the funds from overseas to support lending if the deposits are being pulled out of the system?
Yeah, so it's a funny thing that the money doesn't actually leave the system. You might take your money out of here and buy a house, but that money goes into someone else's bank account, and it does feed its way back through. And we are, I guess, weary of people deciding not to leave it in the banks and trying to do a little bit more with it elsewhere, in which case we would then have to play around with our deposit rates again, and that is a question which remains unanswered, and will probably be tested if we go into negative territory. So as we were coming through, we were worried at around 3% people will rip their money out and no, they won't have a bar of us anymore. We were worried at 2%, and now that we're in the ones, we're still worried, but the money's still there. Whether people put it on a 90-day or just keep it in an ordinary transactional account, the money's still there. But it is a good point. At what point do people rip their money out and do something else with it? We haven't found it yet.
So seeing in Europe, they're getting negative rates on their bank accounts, and that's obviously not dragging. There's still people leave their funds in even at negative rates. So what would be the risk if we do get a negative OCR? What do you think the rationale of a Kiwi investor and mortgage rate holder if we do get negatives?
So the Reserve Bank has been quite clear that they don't want that negative rate to be passed on to retail investors at all, or retail rates at all. So deposit rates will still be positive, but clearly they'll be less positive than what they are today. That they'll be sub 1% to have your money sitting in a bank. And the experience that you talk about overseas was a fascinating one. we saw negative retail deposit rates in Swiss banks and Denmark and a few others. And at that point in time, people were so scared of what was going on in the world, they didn't want to put their money into anything else because they were more worried about losing the whole dollar rather than a couple of cents in the dollar. So it almost became an insurance where you paid the bank for having a safety deposit box to put your money, and that they'll protect it for you basically, but they're not offering you anything for it, and you're actually paying for the privilege of having that account. So that's a bit. I don't think we're anywhere near that yet, but if we go into negative territory, that's clearly a step towards that. And we have seen, this is why I'm against negative rates. We have seen central banks overseas like the Riksbank and ECB actually sort of step away a bit from the negative rates, because what they found over there is it actually forced people to have to save more. So if you're saving for a car or a house or for your retirement, doesn't matter, all of a sudden you've got negative rates or really, really low rates, you have to save that much harder to get to your end goal. And it's the perverse impact. It's the complete opposite to what you'd actually want people to do, which is spend more and invest more.
It makes sense. Yeah, I haven't heard of that one, but it certainly makes sense. So following on from the interest rate side, obviously the forecasting is lower interest rates. Are you seeing any upside risk of interest rates over the next 2 to 3 years with any surprises potentially coming through on inflation? What that could look like?
Short answer is very slim chance. Since 2012, I've been surprised at how low interest rates have been and how they can just keep falling, right? And I'm still of the opinion that the demographic shift that we're all going through, which is an aging population with wealth and savings, and the younger generation coming through with less investment intention, is pushing that skew. So we've basically got an increase in the supply and a big decrease in the demand for money, basically for investment. So the interest rate has gone like that. And the analysis that we've done, the international analysis says it's about 70 to 75% of the decline in interest rates over the last 40 years has been demographically driven. I've done the same thing on New Zealand, and it's 75, 80% of the decline in interest rates that we've seen here in the last 40 years explained by demographics. And then you extrapolate that out, you put right over the next 20, 30, 40 years based on what we think our population is going to do, how it's going to age, how the dependency ratio is going to change. What does that do to interest rates? It just keeps pushing downward pressure on it. So am I worried about the central bank hiking rates in the next 2 years? No, I can't actually see that happening. Do I see an inflationary event that's sustained? Again, not really. We could get, an oil spike. We could get, various things that could push inflation temporarily higher. But I don't see, I guess, the devaluing of the currency type hyperinflationary events, because we're doing crazy things. We've been doing crazy things for over 10 years, or the Japanese have been doing crazy things for 20, 30 years in terms of quantitative easing and playing around, and they still haven't generated inflation. There's some structural issues in there, technological advancements and bits and pieces that keep inflation lower. Not Uber, what's it called? The Amazon effect, the fact that we're trading with each other better. We're going directly to manufacturers rather than going through middle companies. This has gutted a lot of inflation globally, and just given the fact that the rest of the world is going through a much worse recession than we are. Recessions kill inflation. So I struggle to find a situation where we're back to full employment and we are generating sustained inflation that looks like it's going to take off, and for the central bank to both tick those two boxes and say, right, we need to start normalizing rates. Yeah.
Okay, just to follow on from that one there, over the global financial crisis, we tended to see that voluntary change of employment, i.e. going from your current firm and then seeking employment elsewhere. Are you expecting to see much movement in the labour force from a voluntary standpoint?
Yeah, we've heard some really interesting things, pilots becoming, involved in dairy businesses and people adapting. And I think it's about trying to accelerate a lot of that. So we've heard some positive anecdotes of people. Okay, I'm no longer working at Air New Zealand. What can I do? Okay, there's a job over there, and off they go. So we are hearing of those positive shifts, but I think until we get a decent handle on the actual data, it looks like it's going to be difficult, because what we're seeing is or what we think we are seeing is jobs being lost in sort of tourism related, hospitality, accommodation and retail stores, predominantly female, and we're creating construction jobs and trying to think of what other jobs we can create on the other side. So there's clearly a mismatch in what jobs are being freed up, for lack of a better term, and what jobs we're creating. Obviously the government's pretty keen to get female retail people into construction, but I think that might be a little difficult across the board. So it's about trying to create the other jobs that they can be attracted into and get that going, and that will be a painful process, but that's something that ultimately has to be sorted out by small to medium business.
Right.
They're the ones that know what businesses are going to work in the future, not the government. The government just needs to try and facilitate that the best they can with their apprenticeships and trainings and maybe grants to business.
Well, that sort of segues into the next question that's come through. If you had a teen leaving school next year and figuring out what to do for work or study, what advice would you give them entering the current labour market? Are the sectors you view as fairly favourable over the next 5 years?
Oh, I think over the next 10, 20 years, I always think the smarter you are, the more you're into your engineering and your sciences, right? I think with the wave of automation and digital economy that's coming through, the ability to program and be involved with the AI technology that's coming through would future-proof yourself, as best you can. I think we're going to look around at today, and quite a few of us will be automated. There are people that are doing things manually on a phone or manually driving to somewhere else, and all of a sudden there's a machine that can do the phone call for you, or there's a car that can do the driving for you. I think there's going to be a lot of displaced sort of more manual workers over time. So trying to be on that part of the curve. Sciences, again, medicine, that sort of stuff. We're in the middle of a pandemic. I think this is where those sorts of people come to life. But outside of that, I think New Zealand's still got 15, 20 years of huge investment that needs to be undertaken to get us back to where we should have been 20 years ago. So there's still a lot of investment in infrastructure that needs to be done here.
Just following up on that, last time you presented to us, you were pretty bullish on the government borrowing to invest in infrastructure, given our debt to GDP was so low. Given what's happened and obviously the increase in borrowing as a result of COVID-19, do you still stand in terms of the same level of borrowing, or how has that shifted your opinion, if it has?
Still stand. Yep. So we came into this with a net debt of 20%. Our net debt looks like it's going to get to 55%. You look at every other country in the world, every other developed country in the world, they'd love to start at 55%. They're going from 70-odd% up towards 100 and through. So relatively speaking, we're all kind of moving in the same direction, but they're even moving further away than we are. and you would compare yourself to other AAA, AA plus nations, where our debt metrics are so much lower than theirs. I'm not saying it's a great thing that we're increasing debt, but I think if done right, we'll easily pay it back. I think 50% is probably where we should have been anyway. Had we used that money 10 years earlier to build the roads that we're starting to build today. I'm not worried about the level of debt. And if you want to get really sort of out of the box in terms of thinking, who owns that debt? RBNZ. RBNZ's balance sheet is, oh right, it's part of the Crown. Same balance. Oh right, so they own their own debt. Okay. I wouldn't get too worried about it. That was a bit cynical of me, but that's basically what's happening. You've got a government issuing debt, and you've got a central bank buying that debt. The buyer, the central bank, is a very friendly buyer.
Right. Okay. I've got a few questions here, and I'm going to try to tie them in so we're not bouncing from one to the other. But just coming back to the property and interest rate space for a moment, what are you seeing, or what are you expecting to see with regards to Kiwis returning from overseas as a result of the event? Are they likely to set up shop here, bring their cash back, and put pressure on local property markets?
Yeah, I think it's a mixture of all of the above, and I think not just Kiwis. I think there would be a lot of foreigners who would love to come down here and set up shop and put pressure on the property market. But we're talking about Kiwis because they're the ones that can get through. Yes, we have seen quite a few Kiwis get here. We don't get great information about them. You see some press reports that they're just coming here and sitting on the dole. I don't necessarily believe that. It's probably because of the fact they weren't able to get out and look for work. And you've heard a lot of Kiwis coming here cashed up with Aussie dollars or pounds or something, and buying into the market and doing what you say, setting up. And then you've got others, like I've got two mates who flew back straight away as soon as the pandemic hit in sort of March. I think they came back in March, and they've been here all this time, but both of them are looking to leave by the end of this year. Even with the madness overseas, they've just got to get back to where they are. They've basically taken a year working from home in an international job. So some will leave.
And what are you seeing in terms of the mortgage holiday scheme? What needs to happen for banks to actually start pulling in these mortgagee sales? At which point are they going to get nervous and start to pull the trigger?
Good question. Obviously, we don't want to do that, right? That doesn't help us or the customer. What I think is misunderstood in all of this is that banks do mortgage deferrals anyway. When I moved back to New Zealand in 2013, the first time I was trying to get back home, I went to them and said, look, I don't have a job. And they said, yeah, mortgage deferral. How long do you want? Oh, 6 months? Yeah, no problem. So it does happen already. What we have seen internally was a large take up of people doing it during the original lockdown, and then as soon as we came out of lockdown, a lot of them, actually most of them, got on the phone and said, "Oh, can you put me back on P&I, please?" Yep, no worries. And I think there may be a little bit of nerves around this current lockdown, and maybe we get a few more people onto it. But the equity people have got in their homes is quite healthy across the board, and we haven't seen the rise in defaults. That's where people have lost their jobs and just simply can't pay anything back, and throw the towel in type thing. We haven't seen that yet.
In terms of what you mentioned, that the Reserve Bank's not wanting the banks to pass on negative interest rates, that would obviously put a squeeze on the bank's margin. So if you've got the banks getting squeezed on the lending side, as well as potentially not receiving payment on a deferral scheme, do you think that could be significant enough for them to be forced to push people into that position, even if they don't want to? Are shareholders willing to put up with that?
So the deferral one's interesting. I'm not sure exactly how they think through that in entirety. Like, I guess you can't have someone on a deferral forever. 6 months to 9 months, I don't think is the end of the world. Particularly if they've got a decent amount of equity in there, they're going to get a decent job. I'd say as a default position, you'd be pretty lenient depending on the financial circumstances. And most people have got a fair amount of equity that it wouldn't be too much of a big deal. With the reduction in margins and profitability of a bank as you go into those negative rates, you're right, that is a big issue. But that would not mean that we would push people out of their mortgages, right? Those are our assets as much as they're theirs. So that's more an issue around how much money we're making per loan or per business deal. Doesn't mean you unwind those deals.
Right. Yep. Alrighty. A few more last questions. We're getting into sort of over an hour now, so I don't want to tie this up for too much longer. So the overall GDP forecast would indicate that the long-term productivity shows little improvement. Is there a danger that the focus on the short-term realities take our eye off the ball for the very necessary productivity increases in our economy?
And I think that's a brilliant question, and I think that's what we should be kind of pulling up the agenda, because you're right. There is the risk that we see some permanent scarring from what we've gone through, but we've also been given in my opinion, a golden opportunity to do what we should have been doing anyway, and that's the investment in the infrastructure. That's the maybe tackling climate change now that we've got the excuse to pour money into something, and there are people who found themselves out of jobs, and we can create jobs, in cleaning up waterways, for example, or whatever it is. Set the priorities and say, for a more productive economy where we need it to be in 20, 30, 40 years time, we need more of this sort of infrastructure, we need more of these types of houses, we need to tackle these climate change issues, and we need to deal with all these other bits and pieces. And that, I think, is what the next phase of the discussion with the government really needs to be. The first phase was just so brutal, and holy hell, what do we do now to stop unemployment from going up? And the reason we got wage subsidies was simply because of the Kaikoura earthquakes, and they had already had them sitting there ready to go. Had that not have happened, it would have taken probably another month or two for the government to be able to get to a point where they could deliver wage subsidies. So we were quite lucky in a sense that was sitting there on the shelf to be thrown out straight away, and that's why they did it. Bang, it was the easiest decision. Then the next decision, which tried and tested throughout 100 years, is when we go into a recession, a whole lot of men lose their jobs historically. Give them a spade, off you go, start digging a trench. Okay, fine. So this time around, we're giving people spades, but the people who are losing the jobs are actually women, because there's more women in the workforce and it's more of a service issue. So we need to think a little bit more through what else we can do. But I do think there is this golden opportunity to say, we want an economy that looks like this in 20 years' time. What are the sorts of investments we can do today to get there? And we can do it with record low, ridiculously low interest rates, easy access to debt markets. And if we do it right, then that economy in 20 years' time is going to be larger, faster, more resilient, and more able to pay back, whatever debt we take out today to get there.
So this last question here is similar to what you've just answered. In terms of that near term, long term. I guess the key part of this question is, do you think the politicians appreciate the enormity of what they're required to undertake?
Oh, I think they do. Yeah. I don't think I'll be critical of either party. There's enough going on. I think the communication from my personal perspective, the communication with the government and the central bank has been amazing. You know, they've got us on phone calls regularly. You know, chief economists, you know, market analysts, treasurers, CEOs of business. What's going on? What do you need? What are you seeing out there? What are your thoughts on this? If we did this, would you guys understand it? If we did this, would you guys use it? The communication's actually been really good. The ability to execute, I think you could have a crack at any government over, right? Yes, putting money aside to do this is one thing, but actually doing it, like the Kiwibuild experience and other experiences, you know, is another thing entirely. And I think that's the risk, right? You're getting public people to do private people's work, really, and I think the public-private interactions, from what I see, look pretty good. But I think that's where the government will have a better ability to execute, is, you know, rather than sending in you know, an accountant to do a builder's job sort of thing.
Alrighty, well, I'll use this last question I've got here. In terms of where you're seeing the economy, particularly in Auckland, the government seems to be saying level 3 runs at about 70%, but the Herald's saying that only 20% of businesses are estimating full capacity. What is your opinion of the ability of the economy to operate under these different alert levels?
Yeah. Now, I don't know if you can see the bottom right-hand corner of that slide. As a country, if we're at level 3, we're losing 20% of output. That is a little worse for Auckland, though, because Auckland has a much lower primary sector. So primary, you know, farming and the like is only 2% of our economy, and financial services is over 70%. The rest is goods. So, you know, primary is an essential service. We've seen the regions outperform because the farmers are fine. You know, they're still milking cows and doing what they do day in, day out, and they're still receiving, you know, pretty good price for their milk solids, right? And the kiwi fruit growers have actually, you know, receiving huge demand in this COVID world, because it's, you know, it's deemed to be a source of whatever vitamins. So I don't know where you got your numbers from, but it sounded roughly right. You know, that alert level 3 taking 20% from the whole economy. Maybe it's taking sort of 23, 24% of the Auckland economy. And then if you move down to level 2, you know, that sort of 8, 9, 10% being lost. And then we go back to what was our victory state, where we were pretty happy. We're still losing 4, 5% of growth just from our borders being closed. So, you know, that as you increase the social distancing and the lockdowns, there is a significant disruption to certain sectors.
I've noticed, just anecdotally, undertaking my essential travel, is that there seems to be a few more places open this level 3 than last level 3. I don't know if that will come through in the numbers in due course, but certainly there seems to be some shops that didn't open last time that are up and running and trading at the front door, at least.
Yeah, and it happened immediately. I found that really interesting. On the day of the lockdown last week, you know, that Wednesday morning, you know, clients were telling us that Aucklanders were cancelling their travel for the next 2 weeks. Like, we all thought, well, we're all told, I should say, we were going into lockdown for 3 days. People immediately cancelled their bookings and conferences and bits and pieces for 2 weeks. You know, I think you gave me a call on the day and said, let's make it a webinar. We hadn't even been told that we were going to be in lockdown this week. People just knew, right? And we sort of adapted. I do really feel for the urban business, you know, the place underneath our buildings in town, because I don't care how digital click and collect you are, when there's no one in town and they're staying at home in the suburbs, it actually benefits the suburb cafes rather than the ones in the CBD. I think CBD is going to get hit very hard on this.
Agreed. Alrighty. Oh, one comment just came through. What actually happened is Air New Zealand cancelled our flight bookings, so might have been some involuntary cancellations on that front.
Right.
Alrighty. Well, thank you very much, Jarrod, for taking the time and talking to us. It's been enlightening as per usual, and I do hope that might be a push this year, but certainly next year we can get back face to face and hopefully get back into some normalcy. Keeping an eye on these vaccines and what that may do if we ever get to that point. I guess the last point on that is if we never get a vaccine, not quite sure how that's going to impact the New Zealand economy because everyone else may have at least had a bit more herd immunity than us. So let's hope that's not an issue, and we'll probably call it a day there and wish everyone the best of their remaining level 3 for those in Auckland, and enjoy your freedom of those outside of Auckland currently at level 2. And back to usual in what, a week? Is that 26? Everyone back to normal on Thursday the 27th, eh?
We hope.
We hope. Awesome. Hey, thank you very much for that.
Thank you.
Yes.